Wall Street had found the perfect stock, one you'd buy and never sell. Then everything collapsed. The early 1970s, a peculiar mythology had taken hold among institutional investors. A select group of 50 large-cap stocks, household names like Xerox, McDonald's, Polaroid, and IBM, were deemed one-decision stocks. The logic was seductive. These were companies so dominant, so innovative, so destined for perpetual growth that you could purchase them, lock them away, and forget about risk entirely. No need to diversify. No need to time the market. Just hold forever. The prices reflected this almost religious conviction. Investors paid astronomical multiples for these stocks, sometimes 50, 60, even 80 times earnings. A company growing at 15% annually might trade at a valuation that assumed 40% growth in perpetuity. The math didn't work, but emotion and consensus are powerful forces. Fund managers who questioned the narrative faced pressure from clients. Why hold anything else? Between 1968 and 1973, the Nifty 50 outperformed the broader market dramatically. They became self-reinforcing. Success bred confidence. Confidence bred more buying. Pension funds, mutual funds, and wealthy individuals all chased the same names. Liquidity seemed endless. The party felt eternal until inflation spiked, interest rates climbed, and the economic landscape shifted. What happened next was brutal. Between 1973 and 1974, many Nifty 50 stocks fell 50, 60, even 70%. Xerox dropped from $170 to below $50. Polaroid collapsed. McDonald's, once untouchable, became deeply vulnerable. The one-decision narrative evaporated overnight. Suddenly, growth assumptions were questioned. Valuations compressed. The stocks that had seemed immune to risk proved catastrophically vulnerable. The psychological impact was profound. Institutional investors had believed in a new paradigm, that certain companies transcended ordinary market cycles. They learned painfully that no valuation is justified by narrative alone. Growth, no matter how real, must eventually be reflected in prices. When expectations outrun fundamentals, correction arrives with devastating force. The Nifty 50 bubble wasn't driven by fraud or delusion. These were genuinely excellent companies, but excellence and unlimited valuation are separate things. Investors had confused quality with immunity. They'd assumed that a good business, at any price, was a good investment. History would repeat this mistake throughout the decades in technology stocks, cryptocurrencies, and beyond. The lesson persists. Markets reward patience and fundamentals, but they punish certainty. When consensus becomes universal, when everyone believes the same story, that's often the moment the story is closest to ending. The Nifty 50 remind us that even the best companies operate within the laws of valuation, and those laws, eventually, cannot be ignored. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe to uncover how these forgotten bubbles shaped the crashes and manias of today. There's a new historical pattern waiting each week. This video is for educational and informational purposes only and is not financial advice. Always do your own research.